The four richest companies on Earth borrowed $194 billion this year, 79% more than all of last year. And the more they borrow, the higher the rate that holds up their own stock price. Long-term Treasury yields are not coming down. If you have been wondering why long-term Treasury yields are rising, you are asking the right question, because the 10-year and the 30-year are both sitting near their highs of the past 3 years, and the 10-year has parked itself in the 4.6 to 4.7% range. There are usually two answers ready for this. The Fed hasn't cut enough, and the deficit is too big. Both are true, but this year, the market picked up a participant it did not have before: artificial intelligence. More precisely, the companies building AI infrastructure have started borrowing that money in the bond market, and the way they borrow eats into the demand that used to go to treasuries from exactly the same place. So here is what we are going to do. Instead of treating the long rate as one number, we are going to break it into the forces pushing it up and the forces pulling it down, and put them on a scale. We will work out which direction each force is heading, and at the end, we will tell you which way we think that scale tips. The most common mistake with long rates is to see that the rate went up, and conclude from that alone that it is bad for stocks. A rate is a price produced by several forces acting at once. You have to separate why it rose before you can judge anything. The most widely used decomposition splits the nominal long rate into 4 pieces. First, the expected real short rate. This says the market now sees a higher path for the policy rate than it did before. If this rises because growth and productivity expectations improved, that is a relatively healthy kind of increase. Second, expected inflation, the market's view of the average path of prices ahead. Third, the real term premium, the extra compensation an investor demands for locking money up for a long time. Even with no change in growth or inflation expectations, if the future feels less certain and buyers insist on paying less for long bonds, this rises. Fourth, the inflation risk premium. Even with the average forecast unchanged, if the odds of an unexpected inflation shock go up, bondholders demand extra compensation. This is the piece that stirs when confidence in the central bank wobbles. Let us group those 4 into 2. The first and second are about growth, prices, and monetary policy. The third and fourth are the price of uncertainty. That is our map. The left pan of the scale is growth and inflation. The right pan is risk premium. We will fill the right side first. Until a few years ago, AI investment had nothing to do with the bond market, so almost nobody was asking who is funding the AI Capex boom. The hyperscalers built data centers with the cash they earned. A capital cycle running on its own cash is insensitive to interest rates. This year, that condition broke. Goldman Sachs estimates their capital expenditure this year at roughly $750 billion. Their operating cash flow that same year is roughly $778 billion. $778 billion coming in, $750 billion going out. They spent essentially all of it, and there is more they still plan to build, so the cash on hand is not enough, which is why they went to the bond market, either issuing corporate bonds directly or borrowing against assets like memory. And because these companies are so large, this stopped being a funding question for a few firms and became a story about the bond market itself. Amazon, Alphabet, Meta, and Oracle issued about $194 billion of corporate bonds through the 7th of July this year. All of last year came to about $108 billion. That is 79% more in a little over half a year. And this is closer to the beginning than the end. Goldman expects issuance from those 4 plus Microsoft to reach about $250 billion this year and $400 billion next year. The share of capital expenditure funded with debt goes to roughly 1/3 this year and about 35% next year. What matters here is not the size, it is the shape of these bonds. A data center is an asset you run for decades, so the debt attached to it is 10, 20, 30-year fixed-rate paper. which means the supply of long-dated paper that pension funds, insurers, and bond funds have to absorb just went up, and those investors are precisely the people who used to buy U.S. Treasuries. Treasuries and corporate bonds have started competing for the same wallet. So here is what happens. More corporate supply pushes corporate yields up, which makes corporate bonds more attractive. That makes Treasuries relatively less attractive. Treasuries already trading in the market sell off. Their yields rise with them, and when the government then issues new paper, it has to pay the coupon that higher market yield demands. That is the third piece, the term premium, and it is the first channel pushing the long rate up. But if you only count corporate issuance, you will underestimate the pressure. There is a second channel that the statistics do not capture. Hyperscalers are not the only ones building data centers. There are the newer operators people call neoclouds, and there are data center developers. Their credit ratings and cash flow profiles make it hard for them to use the public corporate bond market freely. So they lean on private credit and asset-backed lending, and those loans are mostly floating rate. A benchmark rate plus a credit spread. The problem is that a data center is a long-lived asset, running for decades. If the asset lasts 20 years, but the interest cost moves with the market every month, the operator cannot leave that alone. So they use an interest rate swap. They keep paying the floating rate to the lender, but in the swap market they enter a contract to receive floating and pay fixed. Put the two trades together, and the borrower effectively holds long-term fixed-rate debt. Here is the key. In that process, the borrower ends up on the pay-fixed side of the swap market. Economically, they have handed long-term fixed-rate risk to the market. They did not issue a single corporate bond, and yet the market absorbed almost exactly what a corporate bond would have delivered. And the dealer who took the other side does not simply sit on that risk. They hedge it by paying fixed in another swap, selling Treasury futures, or selling long-dated Treasuries outright. So interest rate risk that started with a data center loan travels through the swap market and lands in the Treasury market. This is exactly the point researchers at the Dallas Fed made in February. The name for this is synthetic duration supply. It is the second line at the window, hidden behind the issuance statistics. To put it together, AI infrastructure investment increases long-dated supply through two channels. The large operators issue long corporate bonds directly. The developers push out something that behaves like a corporate bond through swaps. Both queue at the same window as Treasuries. So is the market absorbing all of this comfortably? The indicators already show fatigue. First, the bid-to-cover ratio. This is the demand thermometer, how many times oversubscribed a deal was relative to what was sold. In February, it was nearly 5 times. By July, it had fallen below 2. Second, how those bonds performed after issuance. Of 91 bonds sold this year, 78 are trading at higher yields than where they came. Higher yield means the price fell. The median increase was about 22 basis points. Third, the new issue premium. That is the extra yield you pay above your existing bonds to get a new deal sold. Last year, it was 2.25 basis points. This year, it widened to 12, more than 5 times wider. Fourth, spreads. On paper of 20 years and longer, the spread over Treasuries widened from 108.5 basis points to 118. None of this is a crisis yet. The widening on long spreads is about 10 basis points, which is closer to a repricing the market can digest. What matters is not the level, it is the pace from here. And when you think about pace, there is one calculation worth sitting with. Goldman calculates that the hyperscalers could take on roughly $2 trillion of additional debt and still keep their investment-grade ratings. Financially, that is true, but the same analysis puts the amount the bond market could comfortably absorb at around $510 billion. Where that gap comes from is the whole point. This is not a question of credit quality. It is a number that comes out of investor convention. In the U.S. investment grade index, even the largest banks each sit at about $175 billion, or 2.3% of the index. The market does not get comfortable with more concentration in a single issuer than that. Apply that convention to the hyperscalers, and you get $510 billion. Two more things sit on top of that. Institutional investors already carry heavy technology exposure and AI-related issuance clusters in very long maturities, like 30 years, which concentrates interest rate risk in one place. So the break on this cycle probably is not the balance sheet. It is the moment some pension fund manager says, "We are sitting this 30-year out." Corporate bonds are not the only weight landing on the right pan. There is the structural deficit and Treasury supply. On top of that came expanded defense spending tied to conflict in the Middle East. Defense spending supports the real economy, but in the bond market, it eventually gets counted as additional borrowing. And this spending has an asymmetry in timing. The administration's budget cuts non-defense spending over the long run, offsetting much of the defense increase. Across a full 10 years, the fiscal effect looks relatively neutral. The problem is that defense spending rises at the front and the savings show up late, which means fiscal stimulus and Treasury supply could concentrate first between 2027 and 2029. What matters to the bond market is not fiscal neutrality 10 years out. It is how much Treasury paper has to be absorbed over the next few years, and the cuts scheduled for later are politically uncertain to actually happen. The market reads that as follows. The spending increase up front is fairly certain. The tightening at the back is not. The Treasury's own advisory committee has been warning it may need to expand issuance of longer maturities. If Treasury supply grows in exactly the window when corporate supply is also growing, the amount of long-dated paper the market has to swallow gets bigger. Same window, longer line. There is one more thing making the right pan heavy. This one is not about supply. It is about information. Fed Chair Kevin Warsh removed forward guidance. Forward guidance is the tool a central bank uses to tell you in advance what it intends to do. The original purpose was to narrow the range of the future policy path and reduce uncertainty. Warsh took it away. Forecasting, he said, is not our job. There is a case for it. It keeps policy from being bound by its own promises, and it makes the market respond to actual data rather than to rumor. But there is a price in the bond market. Even if the market's average expected rate path does not change much, the dispersion of possible paths and the tail risk both get bigger. This last FOMC showed it. Right up to the decision, market-implied odds were split roughly 70-30. Going into a meeting that divided is something we have rarely seen since the Bernanke era. Normally, consensus converges as the meeting approaches. This time, interpretations of the Fed's reaction function stayed split to the end. The blurrier the road ahead, the more it costs to hold a long bond. That is the third piece, the term premium rising. Warsh himself acknowledged that cutting back guidance may have been one factor in the recent rise in Treasury yields. And there is one more layer worth pressing on. Does this uncertainty stay confined to the rate path, or does it reach confidence in how the Fed responds to inflation? Inside and around the Fed, the discussion about treating the inflation target as a range rather than a single point has resurfaced. Warsh has repeatedly emphasized the 2% target, which cleared the immediate concern, but it left the market with a new question. Once 2% is achieved, what framework gets chosen next? While that answer stays blurry, the fourth piece, the inflation risk premium, cannot fully relax either. There is one more thing that could land on the right pan. Shrinking the balance sheet, the return of quantitative tightening. If the Fed starts reducing its Treasury holdings again, the private sector has to take on more of what the Fed had been absorbing. More long-dated paper for the market to digest. Although the current discussion is not only about how much to shrink. Whether to cut the absolute size or the share relative to GDP, how to adjust the mix between long and short maturities. The questions run in several directions. Given that the relevant working group's output may start arriving at the end of this year, an actual policy change most likely comes after that. The market appears to be looking at next year, after the midterms, as the window for a restart, and this is not something the chair decides alone. Whatever conclusion emerges, it needs the committee's agreement before it becomes policy. Not immediate pressure, but clearly a weight that is on the scale. That is the right pan. So what about the left? The first and second pieces made of growth, prices, and monetary policy. Here the picture runs the other way. The core of the Fed's diagnosis is that the U.S. economy is still strong but not overheating. That distinction matters because strong and overheating are different stories, and they call for different responses. The forces holding this economy up are clear enough. Tax cuts and rebates prepared last year, incentives for business investment, and deregulation are supporting activity even against a heavy oil bill. And on top of that, the AI investment boom is lifting output. Warsh described it as a capital investment boom of a kind we have not seen in more than a generation. But that strength is not spreading evenly. Household consumption is growing modestly, and housing continues to lag. New York Fed President Williams reads it much the same way. Some sectors are growing very fast on the back of investment, but weakness elsewhere offsets it, leaving overall growth at around trend. Investment is hot. The economy as a whole is hard to call overheated. The labor market says the same. Unemployment has moved in a narrow band between 4.25 and 4.5% over the past year, and openings and jobless claims have been broadly stable. Governor Waller, looking at payroll growth around 110,000 a month, drew the line clearly. It signals demand is still solid, but it is not something to read as overheating. Employment right now is not the source of inflation pressure. If that diagnosis holds, then the fear of additional tightening driven by an overheating economy, which is what had been pushing rates up until recently, may already be near its peak. This is the first weight landing on the left pan. What about prices? This matters more because the direct trigger for the rise in rates these past months was oil and inflation worry. Taken together, recent messages from Fed officials lean toward the view that price pressure has passed some kind of peak. Williams laid out 5 reasons. 1. The direct effect of existing tariffs has likely been largely absorbed already. 2. Market rents are holding at a moderate rate of increase. 3. Energy prices may already be past their peak. 4. The supply-demand imbalance created by AI investment can ease as more supply comes online. And 5. There is still no evidence the labor market is generating new inflation pressure. Warsh is a little more cautious. 1 good month, he said, does not mean inflation that ran above target for more than 5 years has been cured, and what matters is the trend in the data. But the standard he watches is underlying price pressure, and if that is genuinely coming down, he is inclined to lean toward easing. So the character of the inflation debate has changed. It is no longer whether inflation reaccelerates, it is closer to how long above target inflation persists. That difference is large. The first would demand hurrying into more tightening. The second buys time to confirm whether the slowdown already visible continues. And the biggest variable in that judgment is still oil. There is a pattern here worth watching. Over the past several months, every time military tension escalated, it turned at some point toward negotiation. This time around, China intervened diplomatically, and it also appears to have restrained crude purchases while prices were climbing, which capped a good deal of the increase. The reason neither side can carry a conflict indefinitely is clear too. The U.S. pays in approval ratings, prices, and interest rates. The other side pays in capital and its economy. If this stays a situation managed by negotiation rather than missiles, oil-driven inflation pressure has a decent chance of staying contained. That is the second weight landing on the left pan. So what is this man trying to do? That question matters more than the rate decision itself. Holding rates at the July meeting, Warsh emphasized that both nominal and real yields had risen considerably across the Treasury curve. His read was that the market focused on actual economic data rather than the Fed's guidance, and as market rates rose, financial conditions themselves turned restrictive. The important part is that he did not treat a hold as doing nothing. He described holding rates as not the end of the story, but the beginning of it, and stressed that the rise in market rates and the tightening that came with it is itself a major channel through which monetary policy reaches the real economy. Cut back the guidance, leave the policy rate alone, and the market repricing on its own still works as a transmission channel. Which brings back a picture from earlier. The Fed put the map away, but the market did not stop walking because the map was gone. It started drawing its own, and then it walked ahead along the line it had drawn. The result is the rate level we have now. The Fed never raised the policy rate once, and yet the market pulled long rates up on its own until financial conditions were already tight. Not the Fed's action, but the market's expectations doing part of the policy work. That does not mean he intends to be led by the market. He drew a line there too. Market prices are neither the thing that determines policy nor a perfect source of information, but they remain useful information. So what kind of period is this? In his own framing, it is less a time for patient waiting than a time for careful thinking. Get a more accurate read on growth, on prices, and on what AI is doing to the economy, and then move. The next fork is the Jackson Hole Symposium this month. It is expected to be where Warsh lays out the intellectual framework behind his reforms. How the market reprices the Fed's reaction function after that speech, and how long bonds respond in particular, is the thing to watch this month. Policymakers are not sitting still either. They know the right pan is getting heavy. First, quiet coordination between the Fed and the Treasury. The Fed has been buying short-dated treasuries to manage reserves, and if that continues, the Treasury can lean more on bills and push the burden of longer maturities further out. It does not reduce total borrowing, but it does lower the immediate pressure of long-dated supply. Second, the currency defense window. There has long been a worry that if Asian currencies weaken, those countries' authorities would sell their U.S. Treasury holdings to raise dollars. The Treasury has emphasized a facility where they pledge those securities to the Fed and borrow dollars instead of selling. It blocks the path from currency defense to Treasury selling before it opens. Third, stablecoins. Issuers already hold a meaningful amount of short-dated treasuries as reserves, and with a proper regulatory framework, there is room for more. Although if that money was already sitting in bills or dollar money market funds, only the form changes, and net new demand for treasuries is small. Fourth, bank regulatory reform. The direction is to loosen the balance sheet constraints on banks and dealers so they intermediate and hold more treasuries. Leverage rules have already been eased, and the reforms under discussion include cutting the risk weight on investment-grade corporate loans from 100% to 65%. Fifth, an extension of that. When the capital cost of bank lending falls, a data center operator gains an option other than corporate bonds, a bank loan. It spreads out the path that currently funnels all this supply into the long end. Put together, there is no single powerful measure that removes upward pressure on long rates at a stroke. It is closer to 5 separate things, each absorbing a little of the shock, and they all point the same direction. Push less long-dated paper into the market or make the market able to absorb more. Most of them are still in progress, so the real effect depends on execution speed from the end of this year into next. We have looked at the direction of the forces, but there is a question we have not answered. Is the level itself high or low? Splitting the rate into 4 pieces is precise, but it is cumbersome to run every time. There is a simpler ruler. The anchor for the long rate is roughly real growth plus inflation. In other words, somewhere near the economy's nominal growth rate. That does not mean they have to match exactly. Actual Treasury yields also carry term premium, fiscal conditions, supply and demand, and policy uncertainty. What matters is that nominal growth acts on the long rate like a magnet. Why? Because there is a self-correcting mechanism. Say the rate sits well above nominal growth. That means the cost of borrowing is higher than the rate at which company revenue and household income are growing. The reason to borrow in order to invest or consume gets weaker, credit contracts and activity and price pressure ease. In time, that creates the force that pulls the rate back down. And the reverse works the same way. So the further the long rate drifts from nominal growth, the stronger the pull back toward it. Let us hold that ruler against today. And here something interesting happens. The answer splits depending on whose forecast you put in. Let us take it in 3 layers. First, the world as the Fed sees it. Put in the median of the Fed's own projections, and next year gives you growth of 2.3 plus inflation of 2.3 for 4.6%. The year after gives you 2.2 plus 2.0 for 4.2. Second, the world the economy's underlying capacity allows. The Congressional Budget Office puts potential growth at 2.1% a year over the next 5 years. Add the 2% inflation target and you get 4.1. But that same office sees actual growth falling to 1.8% after 2027. Put that in and you get 3.8. Third, the world, the administration wants. Drop in the 3% growth target, and you get all the way to 5.0%. Lay the 3 layers out, and you get a range from 3.8 to 5.0. But 5 only appears under the most optimistic assumption that the government hits the target it has set for itself. Take that out, and the band is 3.8 to 4.6. The 10-year is currently in the 4.6 to 4.7 range, which puts today's rate at the very top of that band, or slightly above it. And measured against the economy's underlying capacity alone, 4.1 or 3.8, today's rate sits well above. One last thing to check. Is there a signal that inflation reaccelerates? This is how we verify whether the weight on the left pan is real. Something interesting changed here. In the first monetary policy report issued after Warsh took office, money supply analysis reappeared after roughly 10 years, not just M2 growth, but velocity alongside it. Warsh joked that it was an Easter egg he had hidden to see whether anyone actually reads the report, but he was clear that it was a deliberate choice. Why is that interesting? Because the money supply is the central analytical tool of monetarism. The starting point is a familiar identity. Money supply times the velocity of money equals the price level times real output. How much money is out there, multiplied by how fast it circulates, gives you the economy's nominal output. The crux is velocity. If it is stable, you can infer inflation pressure from money growth alone. The furthest this approach ever went was under Volcker in 1979. It did not last. As financial products multiplied and the ways people pay and save changed, velocity moved a great deal, and the relationship between money and prices broke down. So the standing of the money supply kept falling. Under Greenspan, it was demoted to one of many inputs supporting a judgment. Under Bernanke, publication of the broadest monetary aggregate was discontinued altogether. The last time M2 analysis appeared in the report was February of 2016. 10 years later, it is back. So does that mean the Fed is returning to 1970s monetarism? That is hard to argue. It looks closer to the Greenspan approach, bringing money back in as an information variable that supplements a judgment, not as a target. What matters is what that cross-check points to right now. Recent M2 growth has returned to the range you would normally have observed in the 2010s, and most of the pandemic-era surge in real money balances has been unwound. Right after the pandemic, the monetary indicators alone gave a clear signal that policy was extraordinarily accommodative. Today is different. From the monetary side, there is no clear signal that high inflation reaccelerates, which means the view that prices have passed their peak just got confirmed a second time, through a completely different window. Now let us look at the scale. The left side, the first and second pieces made of growth prices and monetary policy, is broadly tilting downward. The real economy is strong but not overheating. Employment is not the source of inflation pressure. Prices have likely passed their peak. And on policy, the rise in market rates is already doing the tightening. The right side, the risk premium, still leans upward. Cutting back forward guidance raised uncertainty about the policy path. Corporate bond and swap supply from AI investment, plus the fiscal deficit, increased the long-dated paper the market has to absorb. And a restart of quantitative tightening remains a potential burden. The shock absorbers are taking a little of that weight off, but most of them are still in progress. So, here is our call. In the 4.6 to 4.7% range, we see more room to fall than to rise from here. Measured against the nominal growth anchor, today's rate is at the top of most scenarios or slightly above, and the growth and inflation forces that drove it up appear to be past their peak. That said, the risk premium limits how far the long end can fall. So rather than short and long rates coming down together, we think the base case looks more like the short end falling faster and the curve steepening. One condition on all of it: this is not a forecast. It is an ordering of the forces we can see right now. If oil spikes again, if the hyperscalers issue faster than expected, or if uncertainty around the inflation target framework grows, this call changes. And over a longer horizon, there is one more thing worth holding in mind. The floor under rates may itself be higher than it used to be. Government-led industrial policy, rising defense and AI investment, and strategic competition between states intervening directly in how capital gets allocated, that environment is quite different from the 2010s, which rested on globalization, fiscal restraint, and low inflation. Lean toward today's rate being near the top of its range in the medium term, while assuming a higher floor over the long term. Those two are not a contradiction. To close, here's the whole thing in one sentence. A capital cycle running on its own cash is insensitive to interest rates. Once it starts running on debt, the interest rate becomes the brake on that cycle. AI crossed into the second category this year, which completes a loop. Capital expenditure eats nearly all of cash flow. The rest gets funded with bonds and swaps. That increases the long-dated paper the market has to absorb. The term premium rises, the long rate rises, and that rate comes back around in two directions. One raises the discount rate and presses down the valuation of AI assets. The other raises the cost of funding the next round and slows the pace of investment itself. This is not a runaway loop. It is a self-regulating one, which is why we think this story ends closer to the pace getting managed than to something breaking. So what should you watch? 4 things. First, Jackson Hole this month. How Warsh explains his framework and how long bonds respond immediately after. Second, the pace of hyperscaler issuance. Watch the bid-to-cover ratio and the new issue premium rather than the headline size. The signal that this cycle is ending shows up at the bond issuance window before it shows up in an earnings release. Third, the quantitative tightening discussion. The working group's output starts arriving at the end of this year, and an actual policy change most likely lands next year. Fourth, execution speed on the shock absorbers. Whether the stablecoin framework and bank regulatory reform actually turn into real demand and wider intermediation capacity. And if you hold this frame up against an individual company, there are 3 questions. Does this company's capital expenditure run inside its operating cash flow or outside it? When it issues, how many times oversubscribed is the book? And has this issuer's weight in the index reached the ceiling that market convention allows? What we covered here is educational analysis, not investment advice. Next month we will check which way this scale has moved.